2023 could be worse than 2008. So what problem does the current Fed chair fight right now? Inflation. So we can't look at 2008 because 2008 was caused by fraudulent lending. And instead we got to go back and look at which recession was created by hyperinflation and monetary tightening. And if we do that, we're going to look at 1980s. So let's go ahead and dive into that.
A more serious domestic problem. That problem is inflation.
So what Volcker was credited for was ending the inflation spiral that started in the 60s, climbed into the 70s, and he ended it in the early 80s. But how did he do that? He did rapid federal fund rate increases. What also was going on in the 1980s? Iran and Iraq were having some troubles, so that caused fuel prices to skyrocket. The other thing that he was fighting was stagflation. In the 1980s, when Volcker started raising the rates, it started about 11.2% for your primary long-term asset fixed rates. Jumped up to 16%. Now that jump was a 48% jump. So at the beginning of 2022, interest rates were sitting roughly around a 3.11 for a 30-year fixed mortgage. By now, they're at 6.49. And that 6.49 is a 108% increase. The increase of the 50%, roughly 50% back in the 80s affected the market so much that it went into a recession. So how much more is 110, 108? And if Jerome Powell comes out here in a week and raises it even further, which then pushes our primary rate up, how much further is that going to affect our market and drive us into a recession? Home prices. So home prices back in the 80s, but home values were only about $55,000 for the median sales price nationwide. But now the median sales price, we're looking at 381,000, floating back and forth around the 380,000, and we're on a downward trend. So that interest rate hike back in the 80s didn't affect home purchases as much as it's going to now, where again, the interest rate, like we just talked about, doubled on a $380,000 mortgage versus a $50,000 mortgage. The other thing that's similar to back in the 80s versus now is we saw that Drysdale defaulted on their loans. We saw that Mexico, their financial minister, came out and they were defaulting on their loans. And so there was mass financial crisis. And what have we been hearing in the news today? Well, we heard just recently that the tech sector has lost $7.4 trillion in 1 year. The tech sector, again, I'm going to say it, the tech sector has lost $7.4 trillion in 1 year. That's a massive hit. And that's not including the FTX scandal where people have lost billions of dollars. Like I said, again, there's very similarities between the 1980s going into 2023. We could see a recession that's worse than 2008 or even 1980. What happened in 2008 or what caused the 2008 recession? There was fraudulent lending, overinflated home prices. It caused a stock market crash.
Traders here working the phone say a lot of their customers are freaked out waiting to see how low the Dow will go.
Massive foreclosure and short sales. What are we facing right now in 2022? Inflation. From the migration from people moving from another state being able to work remote, we're facing fuel shortages. We all know what really is causing that. Facing inflation on groceries, gas prices, everyday living, lumber, home prices. People back in the 1980s believed that Volcker caused a recession. People were very upset, but he was fighting inflation. Inflation was around 14%. So he had to raise the Fed rates increasingly and steeply. What is Powell facing? Powell is facing rising of inflation, and he's trying to bring it back down to that 2%. And he increased rates faster than Volcker did back in the 1980s. And let's look at that in this graph right here. You see this sharp incline of rate increases, and he's trying to combat this inflation. He then corrected it or dropped it below inflation, and he realized, oh gosh, and then he had to overcorrect and raise interest rates, the Fed rate again. If we jump forward to 2008, what we see here is the Fed rate was raising, but because of the economy, the Great Recession happening, they actually had to decrease the Fed rate. But if we look here in January of 2022, we see that inflation is rising. And so Powell is trying to play catch up and he's rising the interest rates fast. What's going on right now with Powell? He is depressing the long-term asset lending. Now remember, I believe that we are going to into a recession. And I said this way back in May when we started hearing about the interest rate hikes, and we had some people that were calling me a tinfoil hat or a Chicken Little or all this kind of things. I'm not saying that I'm right. I'm not saying that I'm wrong, but I do believe that we are heading into recession. And even the Fed and their board, if you look in November meeting minutes, you'll see that they believe that we are likely to see a recession coming in 2023. When people say this is not like 2008, I 100% agree. It's not like 2008, except for the high inflated home prices. But we can't be short-sighted. We have to look beyond and look past the 2008 and look into the 1980s. And in the 1980s, again, Volcker, he suppressed, he depressed the ability for somebody to go out and borrow on long-term assets. And what Powell has done is done that same thing. For instance, back in May, when I first talked about this correction coming, home prices, resale home prices have dropped from May until now of October, 15%. We can see that our home prices are declining, and they have been since May. But how does that affect our market? How does that affect our economy? The housing market provides wages for real estate agents, real estate brokers like myself. That provides wages for lenders, title, escrow officers, builders, developers, investors, the builders, subcontractors. So that'd be framers and plumbers and electricians, dirt work. All of a sudden, people were living this lifestyle, and now they're going to have to cut back. And so then there was a massive wave of people being laid off, of startup companies, as far as like laborers, plumbers, electricians, excavators, all these startup companies, then all of a sudden went belly up because there wasn't enough work to keep them floating enough to make their mortgage payments, their car payments, credit card payments, etc. Oh, look at that, a subscription. Thanks. All right, so let's jump into this graph. It's called the psychology of the market cycle. So these are cycles the markets constantly go through. And we see that it starts with hope, then optimism, then belief, then thrill, then euphoria as the markets rise here in the wave. And then as people get complacent, it cools off for the next rally. Then all of a sudden anxiety happens, right? We're seeing the market kind of drop. And then there's this denial phase. And I think we are in this denial phase because in this denial phase, we have a lot of sellers that are like, no, the market's going to be fine. You hear a lot of real estate agents, a lot of lenders, a lot of different people out there. They're like, oh no, this market's great. This market's great. And they're in denial. But then we look at these builders that maybe have made it through a recession and they're saying, listen, no, we aren't going to wait. We aren't going to deny it like we did back then. And we're just going to go ahead and take our losses and move forward. But I want to end you with some good news because this is kind of not the most friendly news. And we're going to look at, I want to just show you guys the cycle of interest rates. So this graph right here was provided by a friend of mine, Terry Hefner. He's a local lender here, but it brought some interesting insight. So this is a graph of the interest rates. What we see here back in the 1980s, that the interest rates spiked like Volcker, when Volcker increased the federal fund rate. But then as they had to climb out of a recession through the 80s, interest rates dropped. A couple more recessions. Look at the 90s here. And then the interest rates dropped. We had to climb back out of it. Then in the early 2000s, the dot-com bubble. Again, we had a peak interest rate. And then to climb out of the dot-com bubble, the Fed had to drop the interest rates. And so we see this cycle of, oh crap, we go into a recession, interest rates start dropping. So I say that because there is a chance that maybe in the near future, maybe in a couple years, maybe in a year, I don't know, we'll just have to kind of watch and listen to what the Feds are talking about. But we should see interest rates drop back down after the Fed gets this inflation under control. And the other thing that I want to just bring up and touch on is the reason why we say it could be worse is because we have to listen to Jerome Powell and what he's saying. And in his last press conference, what he talked about is he wants to see unemployment rise. So he's expecting for unemployment to rise and he wants to see unemployment rise, but he hasn't seen that. And we just had the jobs report come out and it came out stronger than what most people were expecting. The other thing that he wants to see that wages stop growing. He wants to see the wages almost come to a standstill, low unemployment rate, the competitive job market, at least in the labor sector. I don't see how he's going to pivot and change, even though we're seeing these huge headlines of job losses, because he wants to combat inflation just like Volcker did. If you've been watching the news or you've been hearing anything in the real estate market, adjustable rate mortgages are making a comeback. And you got to be careful if you're going to go into one of those. You get locked in at a lower interest rate than maybe a 30-year fixed. For 5 years, it's fixed at that lower rate. But if in 5 years that rate is higher, then it adjusts higher. And that's what happened in 2008. People got stuck in these arms, what we call them for short. And when all of a sudden that house was worth less than what they thought it would be in 5 years, then they had a short sell or they had to foreclose on their house. How it's the same as 2008. Builders and investors got stuck with inventory that they couldn't unload.